Trader to trader. What Trump is doing to the stock market. Trump is back in the White House, and the stock market is reacting exactly how traders expected, violently fast and with massive sector rotations. But here's the thing, most investors are panicking. Traders, we're licking our lips. Because Trump's policy style creates one thing, we thrive on volatility with direction. Today, I'm breaking down, trader to trader, what Trump is doing to the markets right now, which sectors are getting the tailwind, which ones are getting crushed, and how smart money is positioning. Volatility is back, and it's trader-friendly. Trump doesn't move slowly. He doesn't signal policy. He announces and the market reprices instantly. That means bigger intraday ranges, faster rotations, more asymmetric setups, and more liquidity pockets to exploit. This environment hurts long-term investors. But for traders, this is the best market we've had in years. There are three big macro drivers Trump has unleashed. First, tariffs and trade pressure. Trump's renewed tariff stance, especially toward China, is already reshaping capital flows. The winners are domestic manufacturing, energy, defense, agriculture, and critical minerals. The losers are import-heavy retailers, tech supply chains, and EV manufacturers relying on Chinese components. This is why you're seeing money rotate out of high-multiple tech and into old-school cyclicals. Second, deregulation. Trump is rolling back environmental restrictions, energy-permitting rules, and certain financial regulations. The market impact is simple. Fossil fuels get a tailwind, miners and drillers get faster approvals, banks get more lending flexibility, and small caps benefit from reduced compliance drag. This is why microcap energy and resources, especially on the ASX, are starting to wake up. Third, fiscal expansion and spending. Trump is pushing for defense spending, increases infrastructure acceleration, border security funding, and domestic production incentives. This creates multi-year demand cycles in steel construction, logistics, defense contractors, and rare earths. And this is where ASX small caps can sneak into global supply chains. So how is the market behaving right now? We're seeing risk on in cyclicals, money flowing into industrials, energy materials, and defense. We're seeing risk off in high multiple tech. Uncertainty plus tariffs equals multiple compression. And we're seeing small caps start to move. When volatility rises, small caps lead early because they're cheaper, more sensitive to policy, and react faster to sentiment. This is the early stage of a small cap cycle. Here's how traders are positioning. First, fade the extremes. Trump-driven headlines create overreactions. Smart money fades the emotional moves. Second, follow the capital flows. Watch energy, defense, domestic manufacturing, and critical minerals. These sectors are getting policy-aligned tailwinds. Third, trade the volatility, don't fear it. This environment is built for breakout trades, momentum scalps, news reaction plays, and sector rotation setups. This is where traders outperform investors. And here's what this means for ASX small caps. Trump's policies are pro-energy, pro-resources, pro-domestic production, and anti-global supply chains. That means critical minerals get attention, energy, juniors get attention, domestic suppliers get attention, and anything tied to US supply chains gets attention. Your niche, ASX small caps, is perfectly positioned for this cycle. If you got value from this breakdown, hit like and subscribe. It supports the channel and helps build a community of traders who want clean, honest ASX small cap analysis. Drop your favorite ASX stock in the comments for the next in-depth review. Trader to trader, stay sharp, stay disciplined.